Welcome to the 128th season of the Canadian Club Toronto, Canada's Podium. For over a century, this platform has been a gathering place for visionaries, public figures, and decision makers to discuss the most pressing issues of our time.
We've been having important discussions and debates around this podium in this country for well over a century. I call this a historic podium of record.
Our club's always been a forum for visionaries, public figures, and decision makers to command attention to the issues of our time.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, everyone. Thank you again for joining us, and welcome to those who are joining us online. My name is Tanya Van Biesen, President of Canadian Club Toronto, and your host for today. Private equity has long been a powerful engine of growth, driving innovation and transformation across the global economy. Yet this sector, like so many, is now navigating a significant period of adjustment. So the critical question we are asking ourselves today is, how is private equity positioning itself for continued success in this new environment? Today we are delighted to host our third annual deep dive into the private equity sector, and we are very looking forward to our distinguished panel of guests who are going to discuss this issue with us. Now, our panel brings together voices from across the ecosystem, from global giants to mid-market innovators, to explore the opportunities, navigate the headwinds, and discuss the ongoing evolution shaping private equity today. Our ability to offer you these kinds of conversations is very much based on the support of our partners and our sponsors. So today I would like to acknowledge PwC and Tories for sponsoring our event. Thank you very much. We are also grateful to our season sponsor, Canadian Bankers Association, our airline sponsor, Air Canada, and Canada's Forest Trust Corporation, who helps us to offset our carbon footprint by planting trees in our honor. Now, before the panel introductions, let me share a bit of club information with you. If you haven't already been there, I invite you to visit our website at canadianclub.org. We've got lots of on-demand information there for any of your relatives today that missed today's event. They can get it on demand later or through our podcast. And I also encourage you to share any of your enthusiasm about today's event on your favorite social media platform. Now, this is meant to be a conversation, so we hope that you will send questions up to our moderator, Sandra, today. You will find Q&A cards on your table. So for those who have questions, please fill out the Q&A cards. We will collect them during the conversation and bring them up to Sandra so that she can integrate them into the discussion. And for those who are online, please note that there is a red Q&A button on the right-hand side of your screen. So please feel free to enter your questions when we open the floor for questions. And now I would like to call on Michael Shea, National Private Equity and Pensions Leader at PwC Canada, who is going to introduce all of our panelists. Michael.
Thank you, Tanya, and good afternoon, everyone. On behalf of PwC Canada, we are delighted to return as sponsors of this third annual Private Equity Outlook discussion, hosted by the Canadian Club of Toronto. As 2025 unfolds, we see our private equity clients having to continue to navigate a dynamic landscape shaped by global trade tensions, economic uncertainties, and evolving market conditions. Our distinguished panel has broad experience both in Canada and internationally and encompasses large and mid-market GPs, limited partners, and secondaries investors. This makes them well-positioned to explore how the current environment impacts the industries in areas such as investment strategies, fund liquidity, and value creation initiatives. Now introducing our panel. Please hold your applause until all panelists and our moderator have been introduced. Tate Abels, Managing Partner and Head of Corporate Development and Private Equity at Forum Asset Management. Tori Buffery, Senior Director and Head of Secondaries at Nicola Wealth. Rob Normando, Managing Partner, President and Co-Founder at Seaford Capital. Dave Nowak, Managing Partner and Head of North American Private Equity Investments at Brookfield Asset Management. And finally, our moderator for today, Sandra Bosela, Senior Managing Director and Global Head of Private Equity at OPTrust. Sandra, over to you.
Thanks, Mike, and good afternoon, everyone. I'm thrilled to be here to be moderating this esteemed panel. Rob, Tate, Tori, Dave, I'm looking forward to an engaging discussion today. And as Tanya said earlier, I've got a list of questions here, but I certainly invite everyone in the audience, in person here in the room and online, to bring up your questions. We'd be pleased to answer them. So let's kick it off, and let's start with the macro environment. I think when we would have been sitting here at this time last year, everyone was thinking that 2025 was going to be the year that we were going to return to normalcy in the private equity market. And we all know that didn't happen. We started off the year with the threat of tariffs, which brought on global trade tensions, sparking fears of a recession, rising inflation. We've seen volatility in the markets, equity markets, bond markets. We've seen volatility in the US dollar, the world's reserve currency. Doge cuts, one big beautiful bill, and ongoing geopolitical tensions around the world have continued this uncertainty not only in North America, but around the world. And so with this as a backdrop, I want to open it up to our investors who have a broad range of strategies across the private equity industry to talk about how this is impacting them. So Dave, let's start with you. Brookfield is obviously a global investor. Are you actively looking to do new deals in this market? And if so, what geographies are you looking at and what industries are most attractive to you, and any considerations top of mind?
Okay, I have to first start and explain why I'm smiling. Sandra and I grew up together in Niagara Falls, and so the thought that people would pay to hear her interview me, it's just.
The good news is I have dirt on you, so.
And she reminds me I'm much older, so that is true. So yes, we're like everybody looking for things. Deals are hard to find these days, and in our world, we would characterize things into sort of two categories. We look for industrial businesses, we look for service-based businesses, and what happened, if you think back, a lot of the advisors here will know, 23, everybody was saying breakout years 24, 24, breakout years 25, and so everybody's ready to go. And then the tariffs come. And so what happened in our world was just the whole industrial side of the business, like deal sourcing up, just shut down because nobody really knew how to burden the expenses for industrial deals, right? It's not zero, it's not 100%, it's somewhere in between. And so we have found that all the stuff we were working on, that's just dried up. So then you look to the services side, and when you look at that stuff, it's just too expensive. There's some stuff that's still trading where people are looking for, I would say, 2-turn multiples higher than they actually justify, in part because I think a lot of our peers carry marks at the same valuations, which is, we can have that debate. That's just fundamentally wrong. I'm sure you have a perspective on that. And then on top of that, though, I think they're holding that because there's so much capital that has to go to work, and people are sort of thinking that irrationality will push more towards the services. How was that?
That's great. Tate, maybe let's go to you. Forum's investing throughout North America. What's your view of investing in the US right now, especially as a Canadian investor? And are you looking at investing there, or are you staying in Canada? Are there types of businesses or industries that you're targeting that you will avoid the volatility that we could be facing? What are you looking out for right now?
Sure, and maybe I'll just indulge people and introduce Forum, because maybe in this room it's less known of my peers on the table, but a lot of friendly faces in the room. So Forum, we call ourselves a 29-year-old startup, and we're on the 5th iteration of Forum, and that's as an asset manager that started off as a family office and has bet its balance sheet into growing of the business. So over the last 4 years, we've grown from 5 people to 65 people in the asset manager, and we just crossed $3 billion. And that has principally been led with our balance sheet. And when we find an opportunity we like, then we invite others to invest alongside of us. It could be high net worth retail wealth or individual institutions who align on structure and duration. In our traditional private equity business, we are sector focused around the built environment, which overlines with our real estate activities. And we are agnostic when it comes to how we invest and where we invest. And by that is we're very flexible around structure. So we have minority deals that are highly protected. We have traditional control deals. And that has allowed us in this environment to be very active. We are looking to partner with entrepreneurs. And I think the entrepreneurs are having the same effect that a lot of people in this room are, which was get through COVID. Okay, I got through COVID. Now I can seek a liquidity event. All of this turmoil is happening, and yet I still need to either find a partner for my business or find growth capital. So we have been quite active across the spectrum, from a $20 million deal to a $1.7 billion deal in the last 6 months. And it's really because we are very flexible, opportunistic-wise. I would say, echoing David's comments, valuations still seem high for traditional roll-ups. So we're trying to get early into that and buy more on the book value and build that business. And then hopefully we build a wonderful company that someone in this room ends up buying from us a few years down the road.
Okay. Rob, as a predominantly lower middle market investor in Canada, how are you thinking about the current environment? And talk to us a little bit about your origination efforts, including the industries you're prioritizing, and how you're navigating uncertainty around tariffs in Canada.
Sure, so I'll give a lead in to Seaford as well, because I think we're at least as unknown as Forum. Seaford is a private equity firm based in Halifax. We're in the, I would say, the lower mid-market, so we're investing in businesses that are up to $15 million of EBITDA across Canada. We're actively investing a fund now where we've got 4 platform investments. We've done 5 significant add-ons in those platform investments across industries.
How are we doing? I'm an investor in Rob's fund.
David's,
I came to hear how
that's
we're
a big
doing.
endorsement. Yeah, we got some wonderful investors, including Dave. But,
okay.
But we're doing great.
Okay.
But on the origination side, one of the great things about being at the bottom end of the market, so up to $15 million of EBITDA, but really in that $5 to $10 million range, it's every area is competitive, but it's relatively less competitive. If you think about those 9 transactions we've done, all of them have been unbrokered deals, so all proprietary deals. We spend a lot of our time getting in front of business owners. A lot of what we're doing is selling Seaford to them, and so we're coming in as value-added partners. Because of the size of these businesses, they're not the types of firms that can engage McKinsey or top-tier advisors to help them navigate problems, and so what we're trying to do is help them with that. In our fund, we've got a whole range of levels of exposure to tariffs. And so at one end, we're doing a roll-up of the orthotics and prosthetics industry in Canada. That's a great industry. It's relatively fragmented. If you think about, most of the revenue comes from provincial paying authorities. It's driven by an aging population. It's driven by health outcomes. Almost no exposure to tariffs. We're spending a lot of time thinking about it, making sure we're not missing something. On the other end of the spectrum for us, in December of 2024, we invested in a customs brokerage firm. And so, that's a firm that's obviously very exposed to tariffs. It's their business. And it's been a wonderful, first couple of months. They've never been more relevant to their clients, but they're not taking anything for granted. So they're thinking about how do they build up that consulting piece of the business, preparing for a reduction in trade volumes, which would have an effect on their compliance business. So we're spending a lot of time with them, bringing whatever resources we can to add that value and make sure the management team is thinking about how to take advantage of opportunities in a period of dislocation. And so they're looking several very compelling opportunities to grow that business. There's been a lot of activity. Purelator just bought Livingston. Coal just got picked up by Mullen Group. So we're paying attention to the exposure and trying to bring perspective and value where we can.
Okay. I want to pick up on a comment a few of you made on valuations. What do you think it's going to take to bridge that gap? I mean, we sort of always say, do you work your way through if there is a valuation gap between buyers and sellers? What has to happen? Are we going to go back to creative structures? Do you think once the market just picks up and the uncertainty goes away, that gap goes away? I mean, this is something that we've talked about for the last number of years, and it's come up in a couple of comments. Just curious if anyone has any perspectives.
Well, I could just tack on to what I said. I mean, we've never been a fan of earnouts. You know, to me, they seem fundamentally unfair. When the deal closes, you're managing the business. You should be responsible for the performance. They're a recipe for fights. But we did our first earnout recently just because we couldn't get there. You know, you're trying to underwrite an opportunity in an environment of profound risk. And we sat down with the business owner and said, "We love this business. You got a great management team. We want to do a deal with you." We wouldn't normally say this. The terms that we proposed, we're happy to stick to those terms, even though there's a lot of change there, but we're going to have to add an earnout to this business. Obviously, the initial reaction was not favorable, but we ended up getting there, and we closed the deal on those terms, and now we're in a position where it looking like that earnout will be paid, and as a result of having done the deal on schedule, now we can take advantage of a lot of opportunities. So I think everyone's being more cautious. I think people that have never used structures are using structures, and I think it's out of necessity.
And I think for entrepreneurs, if they truly believe in the business model that they're forecasting, then you're not getting the upfront proceeds, but you should get it down the road for sellers. Great. Okay. Let's talk next about how the macro environment is contributing to innovation and a blurring of the lines of traditional capital pools. So, while the window appeared to be opening in Q4 of last year for a more active market, we've seen a significant slowdown since 2023 in the rate of exits, the level of DPI, and new fundraisings for GPs. So, Tori, maybe let's start with you. How have these trends created opportunities in the secondary market for both GP-led and LP-led transactions? What are you seeing at Nicola?
Yeah, I think us secondaries buyers are the only ones cheering for lack of exits. But this really is a real thing, and it's had a profound effect on the industry. To put this in context, if you have a mature private equity program, you can usually expect you'll get about 30 to 40% of your NAV. You probably have the real numbers, but back in distributions every year. So, and that helps you with planning for deployment and maintaining your strategy. In COVID, that went to 20%, came back for a second in 2021, and now it's 10 to 15%. So if you have a program right now, you're not only over-allocated to private equity, you have no money to invest. And so really, the secondaries market is your only gig in town. As an LP, you can sell to another investor, or hey, if you're not getting any exits from Seafort, you can come to me and we'll do a GP-led together. But this really has shone a spotlight on the secondaries market. I think there was a bit of a taboo before. I probably wouldn't have been invited a few years ago as a secondaries investor on this panel, but we've seen people explore the market where they haven't before. We're seeing a lot of high-quality GPs do GP-led secondaries. So it's been fantastic for the secondaries industry, and it's really shone a light on some of the benefits of investing in secondaries, but also doing a secondaries deal as a GP.
Maybe to the rest of the panel, have any of you pursued a continuation vehicle in any of your funds?
We haven't. I mean, we've got one very large investment in our original structure, and we're looking at it and thinking about it and trying to decide whether it makes sense for us, but we haven't done it.
Yeah, we're not a fan, and it almost feels like it's more of a SPAC type phenomenon. The thing we're trying to decide is whether we should just be distributing directly to our LPs. So the biggest issue, I think, in our world is a lot of the stuff we have is quite large, and so if logical exit is the public markets, you go in the public markets and then you bear market risk for 3 to 5 years. And the thing that we can't square away is, how you can't float half a company in the biggest capital markets in the U.S., right? Like, why is it you can do an offering and a big successful offering is $1 billion? Like, surely, Fidelity and some of the people that are the anchor investors would rather have $500 million in a real floated company than $50 million in something that isn't really a public float. And so I think we're spending a lot of time talking to bankers and trying to figure out different apparatus and how do you actually I'll say, ungum the system. Because what happened was these big assets just used to trade from sponsor to sponsor to sponsor. That seemed to have stopped. And so if you look across the higher, market, I shouldn't say higher market, the larger mega market part, there's a lot of stuff there. It's like, what do you do with it, right? And so one of the ideas is maybe you just float it, and then you send the equity up to the LPs.
Yeah. And what about the flip side? Have you, in your funds, had LPs trying to do secondaries? We talked about allocations have been rising. Distributions have been the lowest levels over the last few years that we've seen in probably over 10 years. Valuations are still there holding, and so for groups that are managing to an allocation, there's been a big problem over the last few years. So have any of you had LPs that have had to go and sell their stakes to try to reduce their exposure?
Not yet.
No.
No, not in our portfolio, but we get the question more frequently, when are you returning capital?
Right.
What's your liquidation plan? It shifted from what's your allocation plan to now what's your disposition plan,
right. Which
the read-through has to be that they're trying to manage liquidity on their end.
Yeah.
Yeah, the one positive is I'd say they're open for business. If we'd had this conversation 2 years ago, the thing that I would have maybe focused on is the sort of recycling capital nature of our industry, and part of why we would say that people weren't exiting was less about valuation gap. It was more about, so you exit, you monetize, and then you want to go reload with another fund, but the pension plans were not allocating because they were already over allocated. So it was sort of, well, why would you do that? Let's work the assets a bit longer. That was the general view. I'd say that part is seemingly solved, because I was at Berlin Super Returns last week, and if anybody thinks they have a special private equity fund, go to Berlin, and you'll see there were 5,000 people there last week, and you realize like what a commoditized industry this is. And
I hope you're not fundraising soon.
No, they don't let me do it. I'm too honest. But what I would say is, like, the one thing that was clear was people are actually actively looking to allocate, and they're trying to find differentiated strategies, and people are looking to do co-invest. That was different than a year ago.
Great. We'll probably come back and talk about that in a few minutes. Tate, can you maybe talk to us about how Forum is thinking about accessing capital in this environment, and what models you think can become more attractive in the future, such as permanent capital?
Yeah, so maybe picking up on David's comment, I agree. I don't think private equity is a unique asset class. It's one of the most global asset classes. It's probably the most competitive asset class out there, and it's illiquid. And so at Forum, we're just trying to think about where can we create an unfair advantage, if we even have an unfair advantage. We like to think we have one. Most times we don't. But if we do, what is that, and how do we allocate our capital around that? And for us, it's really having balance sheet capital. And my partner, Richard, who started the firm, over his history has always rebet his balance sheet back into the business. And we're a privately held partnership. There's no outside shareholders. And our view is let's create permanent capital vehicles. It doesn't mean they're forever vehicles. You could sell an asset if that's what's needed. But our view is we're going to not be in the fund business, in the traditional fund business of raising capital and recycling and all of that. That's a fine business. It's just not where we think that we have an unfair advantage in the market. When you look at our real estate business, it's principally in evergreen vehicles. Long duration assets, long duration liabilities, it makes sense to match your capital source to that duration. In our private equity business, both balance sheet and in our fund, we see long runway in our portfolio. We're not at the point of a continuation vehicle, but we know we will need additional capital. And so that's going to be how we think about going into the business. In the current environment, that means being super opportunistic. It could mean distressed deals. It could mean recaps. It could mean carve-outs from corporations that have bad balance sheets. But all of that, we think, is going to take place in a more permanent capital vehicle. It just works well for us. It works well for our duration. And to Rob's point, when we're talking to investors or partners, that's going to be part of our pitch. Again, not unique in the market, but for us, it works well, and it's how we want to invest our balance sheet as partners in the business.
Rob, maybe over to you on the traditional model. Seafort last raised a fund in 2023, and despite all of what we're hearing on slower fundraisings and challenges in raising funds. You went through, I think, your hard cap or hit your hard cap on your funds. So can you talk to us a little bit about the dynamics you found in that last fundraise, and were there any hot button topics that you really had to get LPs comfortable with?
Yeah, so we were fortunate. We were able to exceed our cap, although it was a very low cap. We weren't really prepared. If you think about our first 10 years, we had something more like permanent capital. When I started Seaford in 2012, I went to members of two wealthy families, the Sobeys and the McCains, and I pitched them on the idea of starting this private equity firm. And we had great success with those investments, and then their support has been amazing. They when we asked them if we could go out and raise a new fund with outside investors, they were very supportive, made lead investments. But we weren't really, I don't think, prepared for some of the rigor that we had to go through to bring in institutional capital in particular. You could sit down with an entrepreneur, a high net worth investor, and explain the strategy, which we're very passionate about. We believed in it. We had good returns to show. But what we hadn't built up was a lot of the policies and other things that sort of, especially at that time, were required. I think we're seeing the pendulum swing back a little bit, but we were making up our ESG policy and all of these things. But having said that, we were principles-based investors. So if you look at our portfolio in that first group of businesses, we had a very strong female CEO who led our business and was driving growth. One of our businesses, our two senior executives who are our shareholder partners, were Indigenous. We didn't know that until probably a year after we had partnered with them. We partnered with them just because they're a great management team that we were excited to work with. We had great diversity across our portfolio. So I think the fundamentals were there. We just didn't have the window dressing and all the meringue that goes on the pie. So we were, frothing that up as part of the process. And I think if we're fortunate enough to go out for another fund, I think we'll maintain that. You'll have to have those peripheral things. You have to have ESG. I think that stuff, you have to prove that you're operating ethically and that you're good people, which we have no trouble doing. But I think there's going to be more of a focus on returns, on strategy, on execution, and I think that's a good thing.
Yeah, and I certainly think as we're holding investments longer, the unrealized portfolio is something I think in this market that everyone is really spending some time on, especially given the challenges that we're facing. So I know it's top of mind in fundraisings. Dave, let's come back to you and we'll talk about the other end of the market from where Rob is. Brookfield just raised your last recent fund. You were at $12 billion, a record fundraising, which is a huge feat in this market. Congratulations. You spoke a little bit about LPs are still looking for co-invest, but what did you see in the last round of fundraising? I mean, historically, we've seen LPs more saying they want co-invest. Have you had them still wanting to do co-invest? Are they doing it in this market? Are you seeing any other different dynamics, the conversations about when are you selling your assets? Are there hot button topics that you've seen at the high end of the market that you've had to navigate?
Yeah, so I would say in our world, people are looking for specialization. So we are an industrial services business. That's it. We don't pretend to be anything more than that. People are saying they don't want this sort of Swiss Army knife approach where people are just generalists in a big fund. So that would be point one. We've also done things where we've sort of pulled out of markets where people were nervous about emerging markets like Brazil. So we've listened to our LPs in some of the areas where they might have some reason to disqualify you or to sort of put you to the back of the line. Co-invest is absolutely active. I would say the co-underwrite is a real thing. Like it was a thing that was sort of starting years ago that, all general GPs were trying to just say, yeah, it's just co-invest. Like, no, very much. We want to be there at the beginning. We want to be on the way through. That's an accepted practice, and it's actually, I would say, quite helpful as you go through. And less about the insights you find, but more about getting to know one another and how you'll manage the asset together. But we have probably 6 LPs that are go-to LPs where you can count on them and they're ready to write checks. The biggest thing is this DPI phrase, which we are, as managers, struggling with because we've always tried to take the view to do what's in the best interest of the long term of the actual investment. And in our world, sometimes that's reinvesting capital back in to reposition it. There's maybe CapEx that's required that otherwise you're getting pressure to try and build up the cash, to distribute cash or push for an exit maybe 2 years earlier than what's in the best interest of the investment.
Yeah, and I think that's where it's just making sure you have transparent dialogue with your LPs. I'm happy to hear as an LP that you The GPs like the co-sponsored deals on the co-investment side, so good to know we can keep pushing for that.
That's because when we get it wrong, you can't blame us because you were there with us.
Good point, good point. Tori, I want to come back to you and talk a little bit about retail investors. There's certainly a lot of interest from retail investors to access the asset class. Do you think that retail investors are equipped to be able to invest in the asset class, and what new structures are we seeing that can facilitate this access?
Yeah, this is a very hot topic right now, especially in secondaries land. South of the border, there's all these 40 Act funds being raised to provide access to private equity for retail investors. So I think I have a unique perspective because I started my career at CPPIB. Most of my career has been closed-end funds. That's what I know, institutional investors. Then I moved over to Nicola, which is retail. And they started their private equity program about 20 years ago, all open-ended vehicles. My vehicle is the only closed-end one they have. So it's been really interesting to watch the differences. And I think, look, giving retail investors or democratization of private equity, however you want to call it, I think is good. I think giving people access to something they haven't been able to historically makes sense. However, I have two big concerns that do kind of keep me up. Well, three, but I'll talk about two. I think the first one is if you want liquidity in a closed-end structure, there's a price for that. And people need to understand that. These open-ended vehicles need to hold a lot of cash that's going to drag down returns, especially as they're deploying. They're going to need to be putting out maybe lower returning deals. So I think investors need to understand that although they're getting access to this asset class, it won't be at the same return levels as you would closed-end, right? That's the price you pay. The second is, right now, there's not a lot of capital in the private equity market, which is private equity's time to shine. That's when we get good prices. That's when we could get good vintages. But if there's a bunch of capital flooding the market, it can negate that. So I do worry we'll lose that recession vintage if we have a bunch of open-ended capital coming into the market. Actually, I'll do my third one.
Go for it.
My third one is that if you want to get out of a fund and you want to get out at the same time as everyone else, you will be stuck in a vehicle that has advertised itself as being open-ended. Again, I have to be careful because my firm is all open-ended, but those are the main three things between us friends that I think about for these vehicles.
And the online universe.
Yeah. It's my name after this.
Yeah, great. Well, I think we've heard certainly there's a lot of demand for access to the asset class, and we're seeing a lot of innovation and structures away from the traditional models to make sure that people are finding ways to access the asset class and find ways to thrive. Let's quickly turn our attention to value creation. So I like to think back to the good old days of the late 1990s where you could buy businesses for 4 or 5 times EBITDA. You could put some leverage on the business, and you probably didn't have to do a whole lot to earn a 30+% return. You would get multiple expansion, and through financial engineering, you could generate a pretty attractive return. Well, we all know those days are long gone, and you can't rely on multiple expansion, frankly, probably even factoring in multiple contraction into base case scenarios, and financial engineering isn't an area where people want to be generating their returns. So maybe I can open up to the panel to talk about how are you thinking and your firm's thinking about risk return these days, and how are you building your value creation playbooks on the true roll up your sleeves hard work that you need to do to generate returns? And do you think we're going to be able to get the returns of the past? I mean, I think we've sort of gone from expecting 30% returns to 20% returns, but where do you see value creation going, and how has it changed over time for you guys?
You want me to go?
Well, maybe we're still living in the 90s a little bit, but we're still doing it. I'd have a mullet if I could. We're not doing deals at 4 times all the time, but we're doing deals at comparatively lower multiples. But the challenge is you're buying a business that needs a lot of work. And so there's, that's a double-edged sword. The good news is there's lots to improve if you roll up your sleeves and dig in, but there's lots to improve. So if you don't drive a good value creation strategy, then you're going to be stuck with something that's very difficult to sell, and the multiples are going to be very similar to what you entered at, or perhaps even lower. The biggest problem we're trying to solve almost all the time is how do you attract top-tier talent to a small company? And that's a big challenge. I mean, if you can fix that, if you can get good management team, the top 2 or 3 people to be strong, to be aligned, then you're going to almost always have success. For us, that's a compensation challenge. So, I talked about earlier how we are selling ourselves to vendors. We're also selling ourselves to management teams. Either you're retaining talent or more often you're augmenting the team with people. If you want to make it compelling, you have to give them a good share of the upside, and you have to tell a story that says, here's what we'd like you to do, here's what we're going to do as part of this value creation strategy, and here's the sort of the track record that we have. It means getting them on board, getting them passionate if that chemistry isn't right. So even if you've got talented people and there's not a good relationship there that you can persevere through challenges and work together on opportunities, and you're going to have a challenge. So for us, when we think about value creation, number 1 is identify top talent, and number 2 is create alignment that can drive success.
Yeah, I think your observations are right, but I think what's interesting, if you're trying to be balanced and not panic, is yes, you have to work harder to actually find misunderstood opportunities where you can actually drive real value. It isn't as easy as just sort of riding the wave, and I think what you'll find is there'll be a sort of haves and have-not separation of people who actually are truly good investors. And I think through this community there are half a dozen people who've just repeatedly been good investors through all cycles. So it will be harder, but I'd say on the plus, there might be more tools with things like AI and digitization. And so the toolkit of what you would do for operating improvements may actually make the improvements easier than historically. And actually, you can accelerate them and get them quicker, which should give you better velocity in your investment. But time will tell. As a guy who, a bunch of people from our group here today will tell you I'm the last guy to speak on technology. But it'll be exciting. Like if I think about our industry, if you're in your 20s and 30s, that is what's going to be. It'll be interesting to see that 10 years from now, looking back. I think you're going to see a lot of really young people that come to the forefront of being known as the real leaders in the industry.
Yeah, that's a great point. Tate, I know your firm has a heavy focus on AI. So how are you thinking of leveraging AI both in your investment process and in your portfolio companies?
Yeah, I think going back to value creation on that, which will lead to AI, I think the first principles are still the first principles about our business. It's just harder to see it. I think what's happened in the last few years is it's become more honest about how GPs make money. I don't think anyone years ago was saying rate compression leading to multiple expansion and arbitraging a platform. No one would lead with that as to how they were making money. And we're in a much more, I think, honest environment around how GPs are actually creating real equity value. Our portfolio is woefully under-levered at the moment. We're less than half a turn leverage across our entire private equity book. So leverage is not part of our tool at the moment. And so for us, we say what's available and how do we go move really quickly. And AI has been that for us. We don't know what we're doing yet, but we're trying to run really fast at it. So 10% of our company now is dedicated to AI. We're building, fancy terms, proprietary tools. What does it really mean? We have a team of people who are building software applications and tools for all of our operating companies and the asset management business. We don't know which ones of those are going to stick. We think about it like your phone. You rarely update your operating system, but you're always trying apps. And eventually you're going to find the 5 or 6 that you use every day. And so the cycle time for our development team, which 2 years ago would have been 6 months to bring out something, is now 6 weeks or it's 6 days. And so that part of it's quite exciting. As an example, to Rob's point, how do you find really good executives, right, to bring to a platform? So we have a tool that marries LinkedIn with external sources and allows you to quickly find good executives and who in your network do you know that can actually vouch for that executive. That used to be phone calls and text and relying on your network, and that's allowing us to identify talent in a much quicker way. We own the 6th largest billboard company in Canada. The lifeblood of that business is local sales. Yellow Pages doesn't really exist anymore. And so our team built effectively a fancy Yellow Pages for our sales team. So it can identify any billboard in the country. It can identify who in that local 2, 3, 4 kilometer radius are good advertisers. It then sources good leads for those people. And so now you turn it over to the sales force and you say, here's high quality leads. go convert that into a funnel. So it's those sorts of things that we're trying out. Some will stick and some won't, but the cost of failure is exceedingly low. It's not dollars, it's more time. And so that's been very fun, I must say. And just in the world we live in, where regulatory burdens are only increasing, understandably, as more investors are coming into the asset class, our Chief Compliance Officer is very happy that we've built her tools that save her 10 hours a week. And so effectively now, anyone who's doing anything public-facing can go internally through our bot, agent, whatever you want to call it, and it identifies 96% of the issues, and then she's only relying on higher-level information, and it's saving her 10 hours a week. So it's those sorts of things that we're doing across the business that are pretty fun, and we're all learning as a firm. But it's such an amplifier of people's talent that I'm just curious why adoption isn't where it is.
Right.
You know, it's adoption at companies is in the 20 to 25% rate. It would be sort of saying, don't use a computer, I want to use an abacus. I don't know why it's not 100%. And so we're having a lot of fun with it.
Okay, great. I want to touch on talent for a second, and then we have a few questions from the audience that we're going to get to. But many of you have talked about talent in various ways, and Dave, you brought up the next generation on leading for AI. But we often talk about how people are our greatest asset. And how are all of you thinking about the next generation in your firms, how you motivate them, how you retain them, how you maybe leverage AI to give them more to do, to give them increasing responsibility. And also, if anyone has any perspectives, as we've been in this industry for quite some time now, not reflecting on any of our ages up here on the panel here, but also from a succession standpoint, from the senior level ranks. This is obviously a big issue to deal with. There's lots of capital that you've attracted, and you want to make sure you get the model right, both to motivate the younger generation, but if you have to deal with succession in your firm, do it in a right way that's going to make people feel comfortable and continue on with your firm. So I'd love to hear any perspectives.
Well, I haven't had to deal with succession yet. But yeah, like I think back to like the worst job or the hardest part of work. And actually, a colleague that I worked with in the depths of investment banking is here, so she'll understand. Oh, she's leaving. Bye, Claire. I was going to say something nice about her. She's gone. But the thing that got you through that was like the person sitting next to you, and like you're going to go out later. It's not like the work and the pay, right, at the end of the day. And so a lot of, and I'm hiring right now, I'm in the process, but a lot of the things that we talk about are being part of something, being part of a team where we're going to do something, we're going to build, and we're going to be there together. I think you just cannot underestimate that, but that also comes with things like being in the office is really important. Like I also have little kids at home, so I don't want to hear them, but I go into the office like every day of the week, and I think that's really important to see people, to socialize, to learn that way. So I think at the end of the day, like, look, you can put all the incentives that you want, but people just want to be part of something bigger than themselves at the end of the day. So that's always been kind of my philosophy on that.
Go ahead, Dave. I would just say I grew up, I'm probably the oldest one up here, and so I grew up in a very HR light world, and my favorite review, which Dave Aiken will remember, was our boss took me in a room and said, "Here's your number, keep on trucking." That was about the best feedback, best review I'd ever had, and so I thought that was amazing. And I remember maybe about 7 years ago, I was on a file, and we had a big meeting coming up the next day, and one of the guys on the file who's really doing all the work, his wife was expecting, and so I went to the young associate and I said, "You gotta be ready to go because I'm not into the details here. And there's a good chance that he's not here." And sure enough, the guy's wife went into labor and we go into the meeting. And the young guy was amazing. Like he just stepped up and he was across the board, and I just sat there, and at the end of the meeting, we were walking back to our desk. I said, "That was absolutely outstanding. You were incredible. You were prepared. You had composure. That was great." And I go to my desk and I get this invite the next day for an hour feedback. And so I went over to his desk and I said, "What's the invite for?" And he said, "I want you to give me some feedback." I said, "I just did." Like that was more feedback than I'd ever. And so in the moment, I remind myself in our group or in most private equity, it's accountants, lawyers, investment like none of us come up trained in really how to manage people. You end up in people management roles because you have longevity. That's really what happens. And what I am actually being taught how to manage people, and that's the interesting part. But the most exciting part of my job, people ask all the time, is like why do you still do it? Because there's a lot of flying on planes, and it's it can be a frustrating existence. It's the people. It's the young people. It's sitting with the young people who actually are smarter than you and actually teach you every day, and actually your days are fulfilled as a result of them.
That's true. That's very true.
Yeah, we've been growing the firm sort of 30% a year the last couple of years, so bringing on a lot of new people. The average age of our team is more than half are under the age of 32 at our firm. And I came from David's world. I was at RBC, and then I was Onyx. Neither are warm and fuzzy when it comes to expectations. But for me, the equation that I talk to, and my partner Rob's here as well, is I think the equation between employer and employee is a little bit different. And so our view is quite simple. When you're with us, we're going to give you the best that we got. And you're going to give us the best that you got. It may be an indefinite stay. It may be a finite stay. But if we can do that in a very open, we're almost radically transparent at our firm. We do a lot of things that make a lot of people in this room uncomfortable about openness around the company, around what's going on across the business, who's ahead of plan, who's behind plan. Every objective in the company is seen by everyone in the company. And so that is an environment that works for some people and it doesn't work for other people, but it's a very open environment. And we'll see, like our turnover is high and good, but it's a different equation, I think, and as opposed to someone just giving fealty to the company, I think the company has to give back to that person in a way where development and growth and tools are part of the equation. And you give people a lot of rope, and you see who wants to step up. And if you can, there's infinite opportunity to do so. So it's been a lot of fun. We have one HR person. She's the hardest working person in the company, but we're excited about where we're doing it.
Great. I'm going to hit one question from the audience, and then we're going to wrap up. We're running out of time. How do you anticipate the regulatory environment to evolve given the growth of the asset class?
It's not getting lighter. How's that?
Well, it's got weren't income taxes temporary and they keep going up?
Yeah.
I think regulatory market is just going to keep getting higher. I think, in your world too, where we bring in bigger investors, they need those protections. I think it's a healthy environment when you have a good regulatory environment, and you just have to manage it, but it's costly. But it's there for the right place. So again, I think AI could be an easy tool for asset managers who are growing to manage that complexity. But I expect it to only increase.
And I think with the entry of retail capital too, regulation is just going to be more and more.
Yeah.
What's remarkable is the breadth and the reach, like going into emails and all the investment committee memos and words you're not supposed to, if in our world, we're looking for businesses that are dominant market share, and I saw AJ here somewhere. I'm not allowed to say that. I can't put that in an email, but it's a fact. It has 70% market share. It's dominant. You can't say that. And so it's that I'm all for investor-focused safety, but there has to be sort of a pragmatic approach to it.
Yeah. Okay, we're running out of time, but maybe I thought for the panelists up here, can you share with the audience any material lessons learned over your career or sort of broad reflections that would be helpful for everyone in the audience?
No, you go ahead, Dave. You're the
oldest on the panel.
The oldest. There we go. Not necessarily the wisest. I have a saying. I only remember one thing from law school, which was I had a prof who said, "You have one reputation, spend it wisely." And I tell my kids this every day because I think it's you look in this room. This is a small community, right? And the interconnectedness of the industry, I get surprised by almost every week. And Rob and I were students at Torrey's for Karen 25 years ago. Tanya and our daughter swam together for over 10 years. We grew up, it's so interconnected. And so I think people make the mistake of being asses, and they do stupid stuff, and it's so short-sighted. And I would encourage everybody, just continue to be a decent person, be direct, have hard conversations, but don't lose your moral compass, because you'll do much better. And that is the difference in this Canadian market. I work in New York, and I can tell you it's a much different existence than it is here. It is a contact sport, there's no doubt about that, but just be careful with your reputation, because you can't get it back.
Other thoughts?
Something that I've reflected on often is deal momentum. Sometimes you're investing time and energy in a deal, and you reach a point often late where you start to have reservations, and that's natural. But if you reach the point where you start to think this isn't a deal that is worth doing, it takes some courage, but you have to step up and just say, look, we're not doing this deal. People are going to be mad at you. The advisors, you'll have sunk costs. And we've done that a couple of times, and it's always better than you expect, and you never regret doing it. Where I've seen people get into trouble is where they push through and close a deal against their reservations because they feel like that momentum has carried them through. And especially in an environment like this, you got to trust your instincts. And if you don't have great conviction, even if the world's yelling at you, don't do it.
Mm-hmm. And similar to something Rob said at the beginning about alignment with management, I think in secondaries, you're always partnering with a private equity firm, and choosing your partner is critical. Going from CPP to a startup secondary shop, I've seen all the types of GPs there are, and you could have the best legal agreement in place, but you need alignment at the end of the day. It's crucial.
Well, I think we've,
I'll just add two things
Final
for me
comments.
is early on someone said, if someone doesn't believe that luck has played a role, don't trust them. So that really stuck with me. And then the other one that has stuck with me is we're not in the business of avoiding risk. We are in the business of pricing risk. And sometimes we fool ourselves and we avoid risk. I think you just need to price it, and maybe your price is too high and the deal doesn't go that way, but we are risk allocators, and so you have to put a price on it.
Great. Well, Rob, Tate, Tori, Dave, thank you so much for an engaging discussion today and for your participation on the panel. Thank you.
Thank you.
Thanks, Sandra.
I will just make a few concluding remarks. So first of all, Rob, Tate, Tori, Dave, Sandra, thank you very, very much for this conversation. You made private equity funny. So number one, we appreciate that. And the breadth of the conversation was great too. So I wrote down a couple of things here. Some of them, no big aha moment, valuations are high, which we know. But what I heard from you is that flexibility and caution can lead to opportunities, and I think several of you talked about that. Tori, it's great to hear that secondaries are having a moment, so I think we should leave the room remembering that. People are looking for unique strategies and specialization, so I also think that that's something important that we need to remember. And then value creation is harder, but there are tools, emerging tools. We're starting to use them, and we need to use more of them. AI, digitization, those are all opportunities for us. And then I was actually really heartened to hear that this is still a people business. So that was a great part of the conversation to remind us all to be in rooms like this. Your reputation is the one thing that you've got, and so to manage that on a person-to-person basis is really important. One takeaway, Seafort needs a marketer, is what I heard from you, Rob. Although I would say that as you continue to describe the strategy, you're an excellent marketer for the firm. So. Thank you all for being here today. Just a quick reminder, we do have another event this week. Tomorrow we are hosting Stephen Lecce, the Minister of Energy and Mines. So if you're available to come, please do join us. Again, visit our website for all of our events. I would like to again say thank you to PwC and Tories for supporting us today and for supporting this conversation. And finally, and always, a thank you to our AV supplier, VBC Live, for expertly facilitating today's event. Thank you all for joining us, and have a great rest of your day.